Good morning. Welcome to Finding Value in Asia's Growth Story, a one-hour programme brought to you by Citywire and Fidelity International. My name is Gavin Lumsden, I'm from Citywire, and with my colleague Jeremy Gordon, we'll be presenting today's broadcast. In a moment, I will introduce you to our guest, Nitin Bajaj, Fund Manager of Fidelity Asian Values Investment Trust, who is joining us from Singapore. Nitin is going to talk about how he looks for high-quality stocks in the diverse equity markets of Asia-Pacific and why he thinks now is a particularly interesting time for his value investment approach. Nitin's going to ask you a quiz question later on, so look out for the Vote Here link in the microsite or the chat box on Zoom to answer that. To give you a practice run, we've got a question to ask you now. It's a simple one. Through which type of investment fund do you currently access the Asia-Pacific markets? And you can either say you don't currently invest in Asia, or you use an investment trust, or an open-ended investment company, or other mutual fund, or you use both trust and OIC. Please select your choice now. And while we wait for the results of that, Nitin, let me introduce you. Nitin Bajaj, Fund Manager of Fidelity Asian Values. Good day, sir. Very good to see you. How are you feeling?
Hi, good morning. I am well, thank you very much. And you?
I'm very well. Well, you know, while people are choosing telling us how they access Asia, it occurs to me you run an investment trust and an open-ended fund yourself. Do you have a preference?
I personally don't have a preference, and I am personally quite heavily invested in both of them to make sure that psychologically I don't favor one over the other. But both of them have advantages and disadvantages, but I use both of them.
That's fantastic. Well, you know what? I think that's probably the right answer, the diplomatic answer, but also reflecting our audience today who are saying that they invest in just investment trusts, or they invest in investment trusts as well as funds. So whether that's with you or with other people, we'll yet to find out. But that's enough for me for now. Thank you very much for answering that question. But Nitin, would you like to begin your presentation, please?
Yeah, sure. What I'll do is I'll take about 5 minutes to explain my investment process and how I go about finding stocks that I invest in. And then I'll spend maybe another 5 to 10 minutes talking about the setup of the market and what's been happening over the last 2 to 3 years, because that's quite interesting and quite extreme by historical, within a historical context. And then maybe last 5 minutes just on how the portfolio looks overall. Yeah. So my investment process is not complicated at all. It's basically what you would do in your personal life with your own money if you were investing in a private business. So if you had £100,000 and you were buying a business in London, what would you do? It's very simple. You would go look for a good business, and by good business I mean something that can generate high return on the capital that you invest and has some ability to grow. Second, you would go and hire the best people to run it for you, people who are competent and people who are honest. And third, you would want to buy it at the best possible price. And fourth, you would try and not burden your business with debt so that the profits that the business generates come to you rather than go to the bank. And that's what I try and do in the stock market. It's not more complicated than that. So in your personal life, when you're buying a business to keep, you don't go to MSCI to ask whether you should own it or not. You don't go and ask an index provider to ask whether you should own it or not. You basically just look at, is it a good business? Is it run by people I can trust? Is it run by people who are competent and doing what they do? Is it available at a price that makes sense to me? And is it financed conservatively? And I just try and do that in the stock market over and over and over again. Now, the problem with doing something like this is that it over-indexes rationality in a way. And stock market, as you know, is an outcome of business performance mixed with a heavy dose of psychology. And at times, the psychology of the market is quite depressive, and you get stocks very cheap. And at other times, the psychology of the stock market is very optimistic, and you get a big bull run, and the stocks get quite expensive. And when you over-index rationality in times of optimism, it becomes a problem, because you're always trying to figure out, is this business worth what the stock market is ready to pay for it? And if you're not ready to participate in things like that, there are times you get left behind. And so it starts to play psychological games on you. So it's very, the rules in the stock market: buy low, sell high. Buy when others are selling, and sell when others are buying. They're very easy to say, they're very hard to do, and they're hard to do because psychology starts to interfere. You know what Warren Buffett says is that nothing irritates a man more than his neighbor getting rich. And suddenly you start seeing people around you trying to make money in all these loss-making companies, and you start doing similar stuff. And that becomes a problem. So it's like most of the problems in investing are psychology related rather than analysis. And what I'm trying to do is always over-index analysis over psychology. Yeah. So investment process is very simple: good people, good business, good price. Don't buy leveraged companies, and just do it over and over again. Now, if we look at what's happening in the stock market, and I said that there are problems when market gets overly optimistic, and I do feel that at the moment, if you look at the stock market, it's very bipolar. There are parts of the market where every probability is priced as a certainty. There are so many loss-making businesses which are priced as if they're going to be the next Amazon of the world, and they're not going to be. There is only one Amazon, right? And there are other parts of the market which are kind of taken as the old economy stocks, or stocks which do more kind of traditional businesses. And there are people who just don't even want to look at them because apparently they are dead, and you can transport goods now without ships and without ports, which obviously is also not correct. So what I'm finding in the stock market at the moment is a massive valuation dispersion. So growth stocks are trading on multiples which we haven't seen since the tech bubble of 2000, and value stocks are also trading at multiples we haven't seen for a long time. So the dispersion between growth and value stocks is almost as extreme as it gets. It started to correct a little bit in the last 3 months, but in the Asian market, it's still very, very extreme, the valuation dispersion. If we can bring up the slide on valuation dispersion, it becomes more clear. And that, to me, is actually fantastic, because I want to own good businesses run by good people at cheap prices. And the market's allowing me to buy a part of the market very, very cheap. It's almost like, if you run a pasta business, you want tomatoes to be cheap. And it's a little similar that if I want to own stocks for the long term, and a large part of the market is being sold off because everyone is infatuated with these technology and healthcare names, then it's fantastic, because these businesses are going to be around in 15, 20, 50 years' time. And I'm getting them today at 5, 6, 7 times earnings, which is fantastic. And over time, rationality prevails. It always does. It's just a question of being patient enough. And so I'm being able to kind of accumulate these businesses. And then if you look at the portfolio as a whole, and if we can bring that slide up on the portfolio valuation, I think it's the next slide, you'll see that the fund's price earnings ratio is at a big discount to the stock market, while its return on equity is at a very big premium to the stock market. And if you think return on equity shows you the quality of the business, right? So the return on equity of the fund being more than the market tells you that the quality of businesses we own is superior to the market on average. And the price earnings ratio being less than the market shows you that on average the businesses we own are much cheaper than the market. And what did I say was my investment process was to own good businesses run by good people at a good price. ROE shows you that the businesses we own are better than the market, and we're buying them cheaper. That's what the price earnings ratio show. So in a way, these two charts capture the whole investment process in terms of how it's coming out. So whatever I'm saying in theory is captured numerically in these two charts. Now, how do we go about actuating the broad process of good business, good people, good price into actual stocks? That's actually not rocket science. The first thing that I do is, for any business, I go and look at the last 15, 20 years history of this business. What did this business do in terms of sales, in terms of margins, in terms of cash flow generation? How was that cash used for, whether it was used for capex, whether it was used for M&A, whether it was given back to shareholders? So basically, what did the business do for its shareholders over the last 20 years? Because a business which couldn't create value for its shareholders over 20 years is unlikely to do so in the next 5. So that's the first thing I do. Just a very desktop analysis of the numerical history of the company. Why 20 years? There's no answer. I just picked it up from Warren Buffett. He looks at 20 years, so I started looking at 20 years. And my experience has been that it's a good number to go by. Second thing, if I like what I see, I will start interviewing the company. I'll start reading the legal filings. I'll go through last 3-5 years annual reports. I'll go visit their customers, talk to their vendors, try and find some ex-employees, get a sense of who these people are and can I trust them. If I like that, then we do a very simple valuation exercise, whether the business is worth at least twice of what we are paying for it. And if yes, we are interested. If no, it can go in a watch list and we may buy it another day. So it's actually a very, very simple process. And we just repeat it. There's no glamour. It's just a lot of hard work, a lot of turning stones. But just keep repeating the simple concept of good business, good people, good price.
Okay, Nitin. Well, that's very interesting. I wondered, listening to you talk about this rotation we've seen from growth to value. Are you glad to see the recent correction in tech and growth stocks? Has the trend become your friend now? And because you've got this prediction, the next 10 years might see a revival in your in value beating growth.
Look, whether I'm glad or whether I'm sad about it actually doesn't matter, right? And whether it's already started or whether there's another leg for growth stocks still to come, or we are already the style change has already started, is very difficult to say. I remember in the year 2000, we were already 6 months into the style rotation out of growth into value. And people were still questioning whether growth was going to come back. And my sense is that this time it's going to be very similar. We'll already be 6-9 months through the rotation from growth into value stocks before we realize that the cycle has turned. Now, the reason I say that this is going to be a long cycle for value stocks is that if you look at the makeup of the market, it's very similar to the way we were in year 2000. The earnings of a lot of these kind of traditional businesses are a bit depressed because of the pandemic in 2020, and their valuations are extremely depressed. And it seems very similar to year 2000, where all the market activity was focused on certain narrow sectors, and almost everything else got ignored. And it feels to me, the setup seems very similar to 2000. Now, I'm not saying that you're going to get the same kind of outperformance of value versus growth that you got last time. It might be more, it might be less, but I do think that when the cycle turns, it's going to be a sustained cycle rather than a short 3, 6, 9 month rotation. It's going to be a few years at least.
Okay, well, that's an important point for people to bear in mind. Yeah, you blink and you might miss it, or wait too long and you might miss it. But looking at the last year's financial results for the trust, I mean, clearly you faced these style headwinds that you've been talking about. Your style has been out of favour. But that wasn't the only thing going on. You held 6% of the trust in Indian mortgage banks, which was clearly which were sold off aggressively when coronavirus struck. Did that underline your determination to run a diversified portfolio? Because it looks pretty diversified what you do currently, but that was a nasty surprise for you, I'd imagine.
Yeah, it was. Look, had you told me in 2019 that 2020 was going to have a virus attack, I would have thought it's a computer virus than a human virus, right? Or people getting sick. So it was completely something that I didn't expect would happen in the world. So a lot of the financial stocks I owned in India did get very aggressively sold off. And what I did during the period of the pandemic was actually take money out of some of the mortgage companies that I owned and put them into some of the other monoline finance companies in India, so truck financing, gold financing. And all these stocks have actually made a very, very strong comeback because the world didn't turn out as bad as people feared in the beginning. So yes, it was difficult when it happened, but we haven't lost money. We've made all our money back and more because the businesses are fundamentally very sound. In terms of whether diversified or not, I've always run a diversified portfolio. And to me, diversification in a small cap fund is important because generally what happens is that if you concentrate your portfolio too much in illiquid stocks, then you can get stuck during bad times or when you make a mistake with a company. And I don't have to say it, but I think there was a very famous fund manager in UK who got stuck with a lot of illiquid stocks. And liquidity is valuable. Yeah. And liquidity is important only when you need it, right? Till that time, it seems like a waste of thought process. So I've always been very concerned about liquidity risk, and hence I've always run a very diversified portfolio. Now, would I like to run a 30-stock portfolio? Of course, I'd love to run a 30-stock portfolio, but I think that comes with huge left-tail risks, which I don't think I should be exposing investors to.
Okay, so you don't run a 30-stock portfolio. How many stocks and companies do you have in the trust?
So it's generally above 100. It'll always be above 100.
Okay, well that is quite diversified.
So it'll be above 100 names, but about 60 or 70 positions. And the difference being that, let's say I like cement companies in India, right? And cement companies, and I'm just taking a theoretical example here. And let's say small cement companies in India are trading at half of replacement cost. It costs $100 per ton to make a new cement plant, and stocks are trading at 50. Now, if I buy one company, I may only get 200, 300 million market cap to invest in. So what I'll do is I'll buy 4 or 5 of them. So now it's 4 or 5 stocks, but for me, it's one position, right? So for example, I own Tianeng Battery and Chaowei Power. These companies together have 90% market share in batteries for electric bikes in China. Now it comes up as 2 names, but for me it's a single position because I cannot invest in Chaowei till I do the work on Tianeng, and I cannot invest in Tianeng till I do the work on Chaowei because they compete with each other. And once I invest in both the companies, my investable market cap becomes more, my liquidity pool where I'm investing becomes more. And so for me, and both the stocks are incredibly cheap. They're trading on between 3 and 6 times earnings. So for me, it's better and lower risk to go with both of them than just to go with one of them.
Understood. When I look at a non-UK smaller companies fund like yours, it's quite often, usually the case, that there are lots of stocks there that I haven't heard of. But one of your top 10 positions is the Taiwan Semiconductor Manufacturing Company, TSMC, which I definitely have heard about, and it's a huge. What is such a huge company? I think it's got a market cap of over 390 billion pounds, if I'm right. And what's such a big company doing in a smaller company's portfolio?
Yeah, all right. So the other thing I do to manage my liquidity is I always keep about 20% of the portfolio in large companies, right? So historically, if you look, 18 to 25% of the portfolio will always be in large companies, which is companies more than 5 billion in market cap. And that can be 6 billion or it could be 600 billion. That I don't care, right? These are large liquid companies. Now, they're there not only for liquidity, but also because I think they give me substantial upside with limited downside. Now, why do I own TSMC? And I own actually quite a big company called SK Hynix as well. And the thesis for both of them is very similar, right? And my thesis is this. As I observe the world around me, and I've owned TSMC for the last 6 years, as I observe the world around me, I see a lot more technology being used in everything, right? From basic things like all the electricity, all the bulbs and fans in my house are now controlled with a remote. So there is a chip in there, right? So everything I do has more technology. That's one observation. The second observation I have as a businessman is no matter which technology hardware you invest in, it just gets commoditized. 20 years back, Nokia was the champion. And then there was a company called BlackBerry, which became a champion. And then a company called Apple became a champion. And for some time, a company called Samsung became a champion. And now Apple is a champion again. And if you go and look at Apple's financial results over the last 4 or 5 years, this company is a fantastic business, great brand, great product. But their margin has fallen every single year for the last 4 to 5 years. A brand like Apple is unable to fight commoditization. Because you can only innovate in technology hardware for so long, sooner or later you're going to get commoditized. Companies like Lenovo, HP, Dell, I mean, these companies make 2, 3, 4% margins. This is an incredibly hard business. So on one hand, I have an observation that the world will have more technology. On the other hand, as a businessman, I've observed that it's very hard to make money with technology hardware companies because over time they're going to get commoditized. So what do you do? How do you solve this dilemma? And the way I've solved it is I've always invested in kind of the toll roads of technology. And TSMC, for me, is a toll road of technology. I really don't care whether Nokia wins or Xiaomi wins or Huawei wins or BlackBerry wins or Apple wins. Their chips will be manufactured by TSMC, right? Same thing, the memory in their phones will be either Samsung, SK Hynix or Micron. There are only 3 companies who can provide that memory. So for me, this is one toll road to invest in. Now, with TSMC, you'll never get the same upside that you can get in a product company because a product can become a hit, but a product will also most likely fail over time. TSMC doesn't fail.
Got you. It's a kind of picks and shovels approach.
Absolutely. And the other thing I've done to invest in technologies, I've invested in distributors. So I own Redington, which is the largest distributor of tech products in India, Middle East, North Africa. I own Metro Data, which is the largest distributor of tech products in Indonesia. So these guys basically take the computers and the phones and the chips and take them from the port of the country of import to the final customer. So they manage the logistics of all these things. So again, you're able to invest in people using more technology, but without taking the product risk.
Okay, understood. Could I just ask you another question, moving on, but can you discuss the importance of dividends to you and the markets you invest in? Because I was struck that you're a value investor, and that's an approach you often associate with higher yields or good dividends. But Fidelity Asian Values isn't a particularly high-yielding portfolio, and your top 3 holdings at the end of the financial year were yielding under 1%. So yeah, where do dividends fit into what you do?
Look, what I look for is total returns, right? Whether it's coming from dividends, whether it comes from buybacks, whether it comes from valuation anomalies correcting themselves. And dividends are obviously, dividends and buybacks are more valuable than everything else because that's a bird in hand than 2 in bush, right? It's coming to me. And the dividend yield on the total portfolio is around 2.7, 2.8%. And the dividend yield for the market is around 2%. So again, it's at 30-40% kind of higher dividend yield than the market. Yeah, I mean, so yes, dividends and buybacks are important to me, and the portfolio overall will represent them. Maybe the top 2-3 positions don't, and the positions under them do. But dividends are a part of the total returns that I look for.
Oh, that's encouraging. I must admit, I was looking at the yield on the trust. I thought that was lower, but your portfolio is generating an above market yield, so that kind of fits with our perception of value investing. I wanted to ask you about ESG. A lot of investors, as a result of the events last year and the coronavirus and the pandemic, a lot of concern with the impact of companies on the environment, on society, and how well they're run. How far are you looking for companies that are making a positive impact on society and the environment?
Look, the first thing I would say is that I've always done this. I know it's become slightly more mainstream over the last 2 to 3 years, and a lot of media's writing about it, and it's become kind of forefront of a lot of investing conversations. But to me, it's fundamental. If I'm buying a business which doesn't respect its employees, or which doesn't respect the laws of the land when it comes to pollution, or which doesn't respect its customers, that's bad business. And you're not going to make money with that business. So for me, it's just fundamental that you have to respect your environment, you have to respect your customers, you have to respect your regulators, you have to respect your employees, you have to respect your shareholders. And that's part of the fundamental analysis that we've always done at Fidelity. So for me, it's fantastic that now this becomes mainstream, and a lot of companies are under a lot more pressure to do the right thing. We've been asking companies to do the right thing for a decade, and we were not taken that seriously in the past, but now with more pressure, companies take us more seriously about these things. So it's very good. What I worry about a little bit is that it's becoming a little bit of a selling point. And with anything, if you overdo it, it becomes bad. If you drink too much water, it becomes bad. So yeah, I wonder if we're going to end up with some mis-selling and stuff like that around ESG, because people are trying to take advantage of this.
Absolutely. There's a lot of talk of greenwashing, and that's quite alarming. But last question for me for now, before we go on to the Q&A. But you've described the style challenge you've faced, but it's striking your trust, Fidelity Asian Values, has done better than its two rivals in the smaller company space in the past 5 years, 1, 5 and 10 years, I think. I've got an easy question for you, but why do you think, notwithstanding the style headwinds, notwithstanding the mortgage bank issues last year, you are doing better than two of your rivals? Is that stock picking? What would you say that is?
The first thing I'd say is there's always an element of good luck. In any success, there is always a little bit of good luck involved, or good fortune involved. So I'm sure we've had our share of good fortune there. But I think the most important reason here would be the depth and the width of Fidelity's coverage. We have close to 50 analysts on the ground in Asia. So we have a research team sitting in Shanghai, research team sitting in Hong Kong, research team sitting in Sydney, a research team sitting in Singapore, research team sitting in Mumbai. We cover these markets on the ground, right? We have analysts visiting companies, talking to vendors, talking to customers, talking to employees all the time. And when you have 50 analysts on the ground, they don't allow you to cover Samsung better, or they don't allow you to cover TSMC better. What they allow you to do is they allow you to turn a lot more stones. And like I said, in this business, there is no glamour and there is no luck actually long term. It all comes down to how many stones you turn and how diligently you turn them. And when you have 50 people on the ground, we just have more man hours. So we can turn more stones and we can do more due diligence. And I think a lot of the performance is basically just down to this competitive advantage that Fidelity has of 50 world-class analysts on the ground. You go and hire 50 world-class analysts in Asia, it'll take you 5 years and millions of dollars to do that. It's just very difficult.
Okay, so you've got a big team behind you there, by the sounds of things. We've got a second question. This is a good time to ask your second question for the audience. So Nitin's talked about the big team of analysts he's got and all the stones there are to pick over in Asia. So the question is, how many listed stocks would you estimate there are in Asia that Nitin and his team have to look at? Do you think they're up to 2,000, 2,000 to 7,000, over 7,000 up to 12,000, 12,000 to 17,000, or do you think they were over 17,000? Please make your choice now, and Nitin, we'll see what you say. I have a feeling, well, maybe I shouldn't say this. This is called to be guiding the audience, but clearly Asia is a huge region and lots of different stock markets. So I imagine there's a lot of work to do. Let's see if we can get a result now. What's your best guess on this? And oh yes, well, Nitin, there's a big majority going for the last option of over 17,000 listed companies. What's the right answer?
It's it's close to 18, 19,000 companies and going up every day because we're going through this IPO frenzy at the moment globally. So it's, I think, 18,700 plus companies already.
That's right. You shared with me a chart earlier on, and it says 18,774 companies listed in Asia Pacific, and that dwarfs the over 9,000 in Europe, 5,350 in the US. So clearly, you've got a lot of ground to cover. Right. Jeremy, it's time to hear from the viewers, and let's move to Q&A. We were just talking about performance and the Fidelity's advantage in picking over all these stones, but I think let's start with one of the questions that we had before today about performance.
Absolutely. Thanks very much, Gavin, and hi, Nitin. So we've got a question from a viewer called Dermot, who says, I'm looking to invest in Asian smaller companies. However, the Fidelity Asian Values Investment Trust has significantly underperformed the benchmark, the MSCI All Country Asia ex-Japan Small Cap Index, a bit of a mouthful, in 2 of the last 4 years by more than 10% per annum. I think Dermot is looking at the net asset value total returns in the February fact sheet, but there was similar info in your presentation as well. So Nitin, moving on from that, can you comment on why that was and why you feel the next 3 to 5 years will be different?
Look, like I showed you in the chart before, the last 2 or 3 years have been that stage in the cycle of the market where people have been infatuated with growth stocks, healthcare, technology, a lot of loss-making businesses, and I just do not invest in these kind of businesses. And the stock market's been led higher by these kind of businesses. On the other hand, the kind of businesses I own have been completely ignored, and actually, in that apathy, not only have these businesses not gone up, a lot of them have actually gone down in absolute value when the earnings and the cash flows of these businesses have gone up. Yeah, I mean, look, you have to go through these cycles in the stock market, and we're going through a cycle where people are infatuated with owning loss-making businesses, and I still believe that the gravity of the stock market is driven, like you have gravity in Earth. I think there's a gravity in stock market as well, and the center to that gravity is cash flows. If a business doesn't generate cash, sooner or later it's going to come down. So I've continued to invest in businesses which are very strong cash flow generators, and they have been out of favor. And so the fund in a couple of years, hasn't done as well as the market. And that's okay. It's just part of what you go through. Like I said, if you run a pasta business, you want tomatoes to be cheap. And I think tomatoes are really cheap at the moment.
Okay. Jeremy, we seem to have a good number of questions here. What sort of topics are coming up before we...
Yeah, we certainly do. I mean, talking about that change in gravity in the stock market, we've got a couple of questions about the shift to value stocks, questions about the geographical exposure, which countries you invest in.
Well, let me pick something. Thanks, Jeremy. Let me just pick up on one from Luke Fitzia. Just picking up on what you're just saying there, Nitin. Part of what you're saying is this kind of argument around mean reversion. What's been doing badly, will start to do well. So Luke's question to you is, do you consider the possibility that your companies may remain overlooked and cheap, and therefore don't re-rate? What happens
For
then?
how long? For how long?
Well, presumably, forever. What if there are big challenges? The growth companies, their momentum continues, and investors' fascination continues, and
So this time it's
Isn't
different.
there a famous quote about don't bet against the market to a certain extent? It will come back. The market can outlast you in your persevering.
Absolutely. The market can stay irrational longer than you can stay solvent. But that applies when you leverage. We don't leverage, right? So I have patience, and I have so far Fidelity as well as the board of the trust have shown faith in focusing on this process. So I have no worries. Look, if you think this style is out of favor forever, then this time it's different, and I don't believe it's different. In the end, every business is worth the cash it generates, and this is a game we've seen before. Look, I've been investing since I was 16 years old, and I've seen this kind of cycle twice before, and you always feel silly. You always feel it's not going to change this time, but it always does. And I've experienced it twice myself, and I've read about it for a few times that happened before I was born. So I don't know if you remember, in '99, people said Buffett has lost it and he should retire. So you go through these things. It's normal.
Absolutely. Okay, Jeremy, do you want to pick up on some of the country exposure I think you were mentioning just now?
Absolutely. So, Nitin, a viewer called Jonathan asks about the exposure you have to different countries and regions. Can you talk about that a bit more, please, and explain in which countries are you finding the most attractive opportunities at the moment?
At the moment, okay. So, look, the first thing I'd say is that most markets are very bipolar at the moment. Yeah. So most markets have extremes on valuation. There are certain stocks which are really expensive and certain stocks which are really cheap. But the places where I'm finding the most value at the moment, or where I think the bipolar behavior is leading to me owning the kind of stocks I like to own, firstly would be Hong Kong, or the Chinese companies listed in Hong Kong. On one extreme you have these loss-making companies trading on $200-300 billion market cap, infinite times earnings. There are normal drug companies trading on 60, 70, 80 times earnings. And on the other hand, you have some really market-leading businesses trading on anywhere between 3 to 6, 7 times earnings. For example, I own a company called Qingdao Port. It's a 120-year-old port, right? A 120-year-old port tells you it has some natural advantages. That's why a port was built there. And it's the gateway port to the Shandong province, which is the largest province of China. This port has grown earnings every single year for the last 10 years. It's got net cash balance sheet. It has grown its dividends every single year since its listing, and is trading on 4 times X cash. A port which has been there for 120 years is trading on 4 times earnings. I don't think this business is disappearing in 4 years. Actually, I'll bet this business is around in 40 years. So Hong Kong gives you a lot of these bipolar kind of stocks. The second place where I'm finding similar opportunities is in India. So in India, again, you have all these consumer names trading on 70, 80, 90, 100 times earnings. And on the other hand, you have certain utility stocks, certain financial companies trading on between 5 and 10 times earnings. So for example, in India, I own this company called PTC India, which is the largest OTC trader of electricity in India. So the problem with electricity is that it is a product which needs to be consumed right at the moment it gets generated. You can't store electricity. So India being a big country, it has a lot of generators and a lot of distributors, and they always they're always not able to buy properly. So you have market makers in the middle, just like you have in the stock market. You have brokers in the middle. This company is trading on 80 rupees a share, gives me a dividend of 7 rupees a share. So my dividend yield alone is 9%. Is trading on 4.5 times earnings, and they own 2 businesses which are up for sale, which will give me roughly half the market cap back straight away. So it will be on 2 times earnings. And again, this is a business which has been there for 20 years, and I'll bet you it will be there in another 20 years. It's not going away in 2 years.
Nitin, those sound pretty compelling examples, so thanks for those. I've just spotted a question I'd like to put to you, just kind of around your expectations from the companies you invest in. This is a question from Mike Prentice. So it's a name that caught my eye because that's the name. I don't know if this is the Mike Prentice, but there was a Mike Prentice who used to be a small companies manager at BlackRock. So it could be a retired UK smaller companies investor, but he's asking, what level of organic revenue growth do you expect to see from your portfolio companies?
Over the next, look, everyone's going to have fantastic revenue growth this year, but let's ignore that because they're all coming off a depressed base, right? On a normalized basis, 6 to 8%.
And why is that a good figure?
Look, a company which can make 15 to 20% ROE and grow at 6 to 8% will make you a lot of money if you're not overpaying for it. So we're paying roughly 10 times earnings for companies growing 6 to 8% and making 15, 17% ROE and not having debt on the balance sheet.
Yes, that fits your schema very well. Jeremy, you got any questions you spotted?
Yeah, absolutely, Gavin. I'd actually like to go back to Hong Kong quickly, if that's all right, Nitin. Colin Shannon has asked which areas, if any, will benefit from the current unrest in Hong Kong. But it sounds like the way you think about it is more the unrest in Hong Kong has thrown up these very cheap opportunities. So it sounds like that's how you're pursuing it.
No, not at all. These stocks are cheap. It has nothing to do with unrest in Hong Kong. Mm-hmm. Because you have to remember, Tencent is listed in Hong Kong. A lot of these tech names and the pharma companies that I'm telling you on 150 times earnings are also listed in Hong Kong. Mm-hmm. These are Chinese companies listed in Hong Kong. Yeah. So they have nothing to do with Hong Kong. They're just listed there. So no, they are not cheap because of the unrest in Hong Kong. They're just cheap because the market is infatuated with growth companies.
Okay. But is that unrest in Hong Kong something you think about at all?
You do. But I think it's whether politically you agree or disagree with what's happened, I think the issue is more or less settled. The Chinese have claimed that this is their Hong Kong is a part of China and it will be governed with Chinese laws, and I think we just have to accept it.
Okay. So as an investor, yeah, you kind of just play the field as you see it then, I suppose. One other quick related question from Peter Renshaw. He points out that about 20% of Fidelity Asian Values is invested in Chinese companies, those listed in mainland China, I think. In light of that, can you please explain what effect the current state of the political relationship, the political tensions between the West and China is having on your investment decisions?
Yeah, okay. So it's not 20% invested in the onshore Chinese companies. 20% includes Chinese companies listed in China as well as Chinese companies listed in Hong Kong. Now, but I think the question is still very valid. Look, again, different people will have different political opinions about what's happening between China and the West, or China and Russia, or China and Philippines. So I don't want to get into a political debate, but I'll tell you my observations as a businessman. Two things are very clear to me. Firstly, the Chinese will insource technology. So Mr. Trump has scared the Chinese, and Chinese will insource as much technology as they can. They do not trust and do not want to rely on the Western world for technology. So they will speed up their technology development, whether it's semiconductors, whether it's memory, whether it's components, whatever technologies they do not own, the Chinese will throw money and talent at it. So they will catch up to the West faster. The second thing, as a businessman, that's very evident to me is that the West doesn't want to rely on China too much either. So the West will move production away from China into other markets. So you're seeing a frenzy of FDI across ASEAN. So actually, I think our ASEAN fund manager was telling me that the ASEAN FDI will be the same as Chinese FDI for the first time in many, many, many years this year. So people are moving production out of China into Cambodia, into Vietnam, into Thailand, into Indonesia, into Philippines, Malaysia, Singapore. Everyone is seeing production move out of China from Western companies into these regions. Same in India, same in Sri Lanka. And these two are, I think, kind of structural changes that have happened. Chinese investing more in technology because they don't want to rely on the West, and the West moving production out of China into other regions because they don't want to rely on China.
Thank you.
I've got one, Jeremy, actually, just a sort of good one from a different topic entirely, but going back to this idea of how many stocks there are for you to look at, and you and your team. Manzoor Mahmood is asking, how do you avoid blow-ups from fraud and accounting anomalies?
Hard work, due diligence. That's the only way. There is no other way. You just have to work hard. Yeah, look, like I said, I've been investing for over 25 years, and I've had my share of blow-ups. Yeah, we've just kind of figured out a system where we are trying to avoid. And I don't think in the last 3-4 years we've been caught in anything like that. Now, that's not to say we won't be in the future. There's always a chance that you might get caught up in something, but yeah, we try and make sure we do the proper work, make sure cash flows tie up with what the business is reporting in profits. We talk to a lot of ex-employees and vendors and customers to get a sense of the integrity of the businessmen that we are dealing with who are running this company. So we do all our due diligence. Will something slip through the cracks? I'm sure one day something will. We just hope it's something small. But we try and do the best in terms of accounting due diligence, in terms of business analysis, and in terms of background checks.
Okay. Can I ask you also about portfolio turnover? That's a question I think, I can't see who's asked that, but I did see it earlier on, and it was something I wanted to ask you about as well. Because Adrian Rossiter, another viewer, thinks that you may have held more than about 100 stocks a few years ago. The portfolio might have been more diversified. Don't know if you've got any comment on that, Nitin, but I'd also like to know, was last year an exceptional year? How many stocks were you selling and new stocks were you bringing in? What kind of turnover can investors expect in your trust?
So historically, my turnover has been about 30%.
3-year holding period.
If you say my average holding period is roughly 3 years, that's what it comes out to.
Yeah, and has
so sometimes it does go up. So like between March and May last year, it went up a lot because the markets had fallen a lot, and it was time to move the portfolio because there were things that got really cheap, and I wanted to go there. So I was selling some businesses and buying some other ones, there will be times where there have been times where turnover's been as low as 7% for a whole year. And there's been times where portfolio turnover's gone up as much as 40-50%, like in the second quarter of last year. That can happen.
When you were responding to last year's market dislocations, when you were seeing that, what sort of opportunities were you responding to? What things were you buying at that busy period?
Look, there's lots of different stocks because I always buy one business at a time, right? So it's a lot of individual stocks that I will have to go through. So there's no trend per se, but I would say more. If you had to find a trend, it would be more kind of old school businesses, which I thought would be temporarily hit by disruption caused by the global pandemic.
Exactly.
So not the kind of new age businesses which were benefiting from the pandemic.
Good. Okay, Jeremy, we're beginning to run out of time. We've got about 9 minutes left. Any other must-have questions we must cover?
We got plenty of questions still coming in, Gavin. Maybe a bit more of a macroeconomic one. Can you discuss a bit, please, Nitin, how sensitive is the strategy to the level of the US dollar? A weakening dollar, something that was being discussed a lot earlier this year, is usually positive for emerging markets. Are you thinking about that much?
No. One of the intellectual mentors I've had is Peter Lynch. And he always used to say that if you spent 14 minutes on macroeconomics, you wasted 14 minutes. I'm not
That's
saying
Peter
these
Lynch,
things are not
the
important.
legendary Fidelity investor.
Yeah. And I'm not saying it's not important, but just because it's important, it's not forecastable. So if you told me exactly where the US dollar is in 1 year's time, I could do something about it, but no one can tell you that.
Okay, thank you. That's fair enough. It might be good to just ask a couple of more basic questions. So as well as the trust, you run a fund. Can you discuss the similarities or differences between the fund and the trust?
Look, there are a few differences. Firstly, the trust has more privileged capital. An open-ended fund is T+1 liquidity. You want your money back tomorrow, I have to give it back tomorrow. While a trust has privileged capital in the sense it's perpetual in nature, right? I don't have, the capital stays with me till I get fired or I retire. So I'm able to take more illiquid positions in the trust than I can in an open-ended fund. So there are certain small stocks where I wouldn't own them in an open-ended fund, but I will own them in a trust. So the overlap is about not 100%, it is about 94, 95%. There are certain businesses which I own only exclusively in the trust, not in an open-ended fund. The second is obviously the trust has the, because it's perpetual capital, I don't have to keep a cash buffer. So in the open-ended fund, I always keep 5% cash buffer. If you want your money back tomorrow in the open-ended fund, I'll give it back to you. And if I don't make money with the 95% I invest in the open-ended fund, forget the 5% I don't. But in the closed-ended fund, I don't have to keep any cash buffer. I can invest more or less the whole amount, or even take on a little bit of leverage in times of extreme pessimism. These are the two primary differences in the funds.
Okay, thank you, Nitin. One thing I'd like to ask you about, returning to the trust, investment trust shares can trade at a discount to net asset value. I think the discount which your trust is trading at has come in a little bit recently to around 2%. Can you please explain to us what kind of policy, if any, you have in place to manage the discount?
I think the board, that's not up to me, that's up to the board, because I just manage the portfolio and discount and premium management is done by the board. But I think they've been quite pragmatic as well as diligent about it, in the sense that when the trust was trading at close to a 10% discount, they were buying back shares. And when it went to a 5-6% premium, they did issue some shares to make sure that they keep it around NAV. So they've been quite good doing that. And so it's a very pragmatic way of doing it, rather than having a fixed written policy.
I think we're getting close to our time, but maybe listen, think about a concluding remark or two. But I'm just maybe I'll pitch it this way. I think I'm right in saying the investment trust has a continuation vote at the annual general meeting later this year. Just assuming there is one, okay. So everybody here has got to vote on whether Fidelity Asian Values Investment Trust should continue or not. Yeah, just give us the why Fidelity Asian Values should carry on existing if this was a continuation vote right now. What's the essential appeal right now?
Look, the appeal is what it's always been, that I think Asia is a growing part of the world. So if you want exposure to Asia, there are two ways to do it. You can go with a normal large cap fund, you go with an index fund, but there is a large part of the market. Like we said, there's more than 18,000 listed companies in Asia. When you go with the larger funds, you get exposure to maybe the top 200, 300, 400 companies, right? And the history of the last 15, 20 years in Asia was Asia doing a lot of stuff for the Western world, right? Asia was just a manufacturing place. The place where Asia has reached now, especially China, is that Asia is going to do a lot of stuff for Asia. Chinese are going to make stuff for Chinese. Indians are going to make stuff for Indians, the way America and Europe grew. And this is going to lead to a lot of businesses in niches, entertainment, cinema halls, toll roads, little businesses, which you won't be able to access through a lot of these large stocks. Now, I know last 5 years have belonged to large cap growth companies, and it's very seductive to say, okay, why do I need a small value fund when large cap growth has done so well? But do remember that market has cycles. We are trading at an extreme valuation for small cap value stocks versus large cap growth stocks. And if you look at the last 20-year history, the best place to invest in Asia has been small cap value, right? Over 20-25 years, it's done better than large cap growth. It's done better than large cap value, and it's done way better than small cap growth. Not only have the stocks done better, they've even grown earnings faster. So not only do small cap value stocks do better as stocks, paradoxically, they outperform growth companies on growth. So growth companies are growth companies in perception, not in reality. The fact is, value stocks grow earnings faster than growth stocks in Asia, at least. I don't know about the West and US and Europe. In Asia, we have the data for the last 20 years, 25 years. Value stocks outgrew growth stocks on earnings, not on sales, on earnings. Yeah.
Well,
and so you're buying these stocks. So as a trust, we are invested in this part of the market. We have the best research team, and to me, that's the reason to own it, and that's the reason I own it. But every investor will have to make up their mind if this is what appeals to them or not.
Of course, and they will do. And you've given them a lot of information to think about. So thank you very much for your time today. I think your concluding comments there, around growth versus value, are really quite fascinating. Value is outperforming growth over a long time. Does it begin to sort of beg the question about the usefulness of these distinctions between value and growth? I'll leave you with that question. You call yourself a value investor, but value growth, they're just different sides of the same coin, are they not?
Look, they are. In the end, no one is silly in the stock market, right? People just are coming from different kind of intellectual constructs. Everyone is looking for buying a stock which will go up, right? Or they're looking for margin of safety in what they're buying. As value investors, I look for margin of safety in the valuation as well as the quality of cash flows. A growth investor may look for margin of safety from the business's ability to become bigger over time. My experience tells me that it's much easier to understand quality of cash flows and the starting valuation than it is to forecast growth. It's very hard to forecast growth. So as value investors, we look for margin of safety in quality of cash flows as well as the valuation, and growth investors look for margin of safety in ability of business to grow. But in the end, they are like parts of different sides of the same coin, isn't it?
Brilliant. Well, I'm glad you agree with me on that point. Nitin, thank you so very much for your time, and thank you to Jeremy for moderating the Q&A with your usual aplomb. Thank you. That's all we've got time for, but thank you very much for tuning in. We'll be bringing you more programmes on Fidelity's other trusts in the coming months, so please do watch out for those and tune in. But in the meantime, goodbye and happy investing.